We request to join the stage, please, sir. Sanjeev sir, Nero bhai, Jai bhai.
Hello everyone. It is my pleasure to introduce CA.Sanjeev Shah. CA.Sanjeev Shah is a practicing chartered accountant and founder of MS Shah Sanjeev and Associate, Vadodara, with over 30 years of experience in a merger and acquisition, forensic investigation, cyber security, internal control, and business restructuring. A science graduate and chartered accountant, he is also certified fraud examiner, ACFE, USA, and hold a cyber security certificate from ISC to USA. He served as a chairman of the Baroda branch of ICAI in 2003 and is currently a co-opted member of ICAI's Digital Accounting and Assurance Board for the financial year 2025-26. He has held independent director role in PSU like Concor and its subsidiaries and served as a SEBI nominated public interest director at Vadodara Stock Exchange. He has also functioned as a category 4 merchant banker and SEBI arbiter. Thank you, sir, for taking the lecture. Now I request to give memento to sir. Nirav sir will give memento.
So, good afternoon, friends. Of course, I know it's very difficult to make you awake in the post-lunch after having such a sumptuous lunch provided by the branch. But it will be my endeavor, let me tell you, to my endeavor to see that nobody sleeps for the next 2 hours, right? Because the subject is such that it will definitely make you awake in the next 1.5 to 2 hours. And then each and every slide, let me tell you, will be definitely important for you in the time to come. So thanks Ahmedabad branch, first of all, for inviting me. It's both an honor and privilege to address you all in today's session on learning from lapses. आजकल हमने बहुत पढ़ लिया, पढ़ते रहते हैं, right? We learn a lot from different seminars, conferences on audit, taxation, corporate governance. But so far we have not learned anything from our lapses. What kind of mistakes we day in, day out do while auditing the client accounts. So the topic is selected, learning from lapses, enhancing audit quality through NEFRA insights. This presentation has been completely prepared from the resource NEFRA, right? Because all the material has been taken from NEFRA, their inspection report, their understanding, interpretation, and advice to the professionals. So, as practitioner dedicated to upholding the highest standards of financial integrity, our collective commitment to excellence in auditing is paramount. I mean, that goes without saying. NEFRA serves an independent regulatory body, oversees accounting and auditing standards in India. Its inspection, investigation report, and disciplinary orders have brought to the fore not only instances of non-compliance and professional lapses, but also valuable insight into systemic deficiency and area needing reforms. Very important, NEFRA is not a substitute, but a parallel regulator for a defined class of auditors. ICAI continues to regulate all members, but NEFRA has exclusive override where it applies. I will explain this. The focus will not merely on identifying what went wrong, right? But more importantly, on asking, how can we do better? How can audit firms strengthen their internal controls and quality review mechanisms? How can partners and engagement teams ensure compliance with standards on auditing and SQC1 in letter and spirit? Now, before I start my presentation, how many of you have so far visited NEFRA website? Can I have some idea? Very frank admission. How many of you has visited NEFRA? 1, 2. Okay, good. So, majority of you have not visited NEFRA. So, for all of you, then it becomes very important to look at the presentation, the contents which has been presented. So, now let me touch upon, since many of you are not aware about the NEFRA regulations. All listed companies and large unlisted private companies with paid up capital of 500 crores and more, annual turnover of 1000 crore and more, and aggregate outstanding loans, debenture and deposit of 500 crores or more are covered along with banking, insurance and electricity generation companies. Auditor of these entities are required to comply with NEFRA regulations. At the same time, NEFRA can initiate suo motu action under AQR, Audit Quality Review, on receipt of whistleblower complaints and reference received from SEBI, CAG or MCA under section 132(4) of the Companies Act. Now, I'll also touch upon very briefly about the penalty NEFRA can impose, right? For an individuals, a fine between rupees 1 lakh to 5 times of the fees you have received for a particular year. For firms, it is 5 lakhs to 10 times of the fees received. For individual, 1 lakh to 5 times the fees, and for firm, 5 lakhs to 10 times of the fees. And then NEFRA can debar with minimum of 6 months to maximum of 10 years. So, this is the seriousness of the NEFRA investigation, and then if auditor or member is found guilty, then they have to face the music. How many of you are auditor or associated with the audit of listed companies here? Okay. Non-listed company, but then with a higher turnover of 1000 crore and more, and then aggregate debt more than 500 crores. Okay, fine. Very few, but the rest of the you guys don't be under impression that you are not going to be covered in the time to come, because some of the slide I have taken up will definitely show you that others are also can be under radar of NEFRA. So, my the structure of the presentation would be covered into 3 broad major parts. One is the audit. The first is audit failure overview. What kind of failures are observed by NEFRA and investigated, followed by the case studies and the key standards, violation of the key standards of auditing, and the key takeaways for the auditors. Say mistakes से में हमको कुछ सीखना है, right? So these are the takeaways for the auditors. Now, very important slide. The NEFRA has identified almost 10 major lapses and failures while auditing the books account and issuing the reports. One is failure to report material misstatements, improper reliance on management representations, inadequate risk assessment and planning, neglect of fraud risk procedures, very important nowadays, deficient audit documentation, extremely important, no verification of recoverability and provisioning, misuse or omission of modified opinions, non-compliance with the key standards on auditing, related party transactions not properly audited. Last but very important again, engagement quality control review EQCR and standard on quality control SQC1 failures. These are the 10 failures NEFRA has observed. Now we'll go each one by one, followed by the case study, then auditors' mistakes and the key takeaways for the respective failures. Number one is failure to report material misstatements in the audit report. Now, before we start, we should understand the definition of misstatement. A misstatement is considered material if it could influence the economic decisions of users taken based on financial statement. आपने कोई financial statement से ऊपर से कोई economic decision ले लिया, either to invest in the equity of the company or deposit in fixed deposit, invest in fixed deposit, then it is considered to be a misstatement if later on the financial statement were found to be wrong. Now, if auditor identified a material misstatement in financial statement which is either not corrected by the management or the misstatement is so significant that it affects true and fair view of the financial statement, what actions are required? Standard of auditing 705. Now, before I start this, so far I observed and I know many of us so far have not read or not aware about the standard on auditing. Accounting standards के लिए हमने काफ़ी कुछ पढ़ा है because we have attended lot many programs and seminars and all, but few have attended the programs on standard of auditing, and the NEFRA is purely concentrating on violation of standard of auditing. So, under 705 for a material misstatement, a modified opinion is required if the misstatement is what kind of modified opinion? If qualified for material misstatement but not pervasive. The effect is material but not pervasive. What is pervasive? Either it is extensive, widespread, affects true and fair view of the financial statements. The modification can be adverse if the misstatement is material and pervasive, or disclaimer when sufficient evidence cannot be obtained and possible effects are material. Why it matters? A clean report implies that financial statement represent true and fair view. If the auditor knows that numbers are inflated, manipulated or unverifiable, but still it gives a clean opinion, it becomes a false assurance. It undermines public trust, compromise integrity of financial reporting, which lead to financial loss and regulatory failures. Excuse me, sir, can we increase the AC of the, I think found this problem? Okay. Okay. So, now let us understand the types of material misstatement observed by NEFRA, right? Fictitious equity infusion, because all these observations have come from the case studies NEFRA has investigated, right? So, in this case I am going to present 4 case studies. One is for a Brightcom Industries, another is the Z Entertainment, and later on is the Sobha, is a real estate company, and Banpur Cement. So, in case of Brightcom, fictitious equity infusion, share capital recorded without issuing actual shares. Artificially inflating the company's net worth by issuing the clean audit opinion. Round tripping of funds, in case of Z, funds cycle through intermediaries and back to group companies, and this transaction lack economic substance and designed to deceive auditors and investors. Unsecured advances without recovery plans, large advances paid with no recovery plans indicate high risk of default and potential misappropriation of funds. This can hide the diversion of company's assets. And undisclosed liabilities or NPAs, failure to report tax demand, bad debts, overdue loans. Omission can have significant legal and financial consequences. These are the types. And now let us understand the case study number 1 of Z, where 200 crores was improperly shown as advance, but was actually routed to various group entities through unrelated third parties. No audit qualification. Auditor issued a clean audit report and did not go for an audit qualification. What NEFRA found out? NEFRA found that material misstatement was ignored during the audit process, leading to clean audit opinion that did not reflect the financial issues within the Z Entertainment. This was the case study of Z. Second case study on Brightcom Industries, where I mentioned about a fictitious equity infusion. 867 crore were shown in the books as a preferential equity issue, but majority of the book, it was the funds were received through the book entries and journal entries. Auditor did not raise the issue, auditor did not qualify. Money was recorded as equity, and investigator revealed that funds were potentially routed through shell companies. Failure, auditors failed to report. Despite red flags, auditor issued clean opinion. This is a serious lapses in diligence. Regulatory scrutiny, later on it was investigated by SEBI and then followed by NEFRA. SRS Limited and Sobha Limited, in case both are the real estate companies, and then many of you do audit of real estate companies. Here, substantial advances to the guru companies without insurance recoverability. Audit opinion, despite heavy losses and NCLT proceeding, clean audit opinion was issued, raising concerns about audit quality. In some of the companies where the loans were given, the NCLT proceeding were started. So it clearly mentioned about the recovery of the loans granted to those companies. Despite that, despite the recovery issues, the auditor did not go for the provisioning and issued a clean report. So it's a lack of advances, lack of recovery of advances contributed to the company's financial instability. Sobha Limited also 1800 crores were given as an advance without proper diligence for land ownership. These advances were given to purchase the land, which is a real estate company, and without any documentation, without the recoverable, without the financial stability or financial strength of the company who received the advances. So this significant issue was not reported, not even reported as a key audit matter. Not even reported. I mean, minimum it should have been gone to the key audit matter, and then it should have gone to qualification in the audit opinion. So it's a compliance issue, raising questions about the land ownership. Now, what are the professional misconduct? You must know that clause 5, second schedule of CA Act says that failure to report known material misstatement leading to financial irregularities and undermining investor confidence. Clause 7 and 8 also says about negligence and lack of sufficient information gathering resulting in inadequate audit evidence. And 705 auditing standard auditing says no modification despite pervasive misstatement indicating serious breach of auditing standards. So NEFRA has not formed up any regulation. They only look at the CA Act, in which the professional negligence is clearly defined. How auditors should respond to misstatement? If they find out the misstatement, they must communicate it to those charged with the governance. Now, in the NEFRA website, you will always find the word TCWG, those charged with governance. It typically includes the board of directors or the audit committee or chairman audit committee. Assess impact. Auditor has to determine if misstatement is material and or pervasive, and then if it is quantitative and qualitative, having the quantitative or qualitative factor. Now, what about the quantitative factor? If the, it all again goes on a material threshold, auditor has to define before the audit process starts. Normally, it is 5 to 10% of the PBT, or 0.5 to 1% of the revenue, or 0.5 to 1% of the total assets. And then qualitative misstatement, even if it is a very small amount, if it has violated the regulatory compliance or a bank covenants are missed, then it becomes the qualitative misstatement despite the threshold limit auditor has to go for. In a bank loan statement, bank loan document, if it is clearly mentioned that the promoter will not divert the funds to the relatives without the permission of the bank, specific permission, and if the auditor found out only 2 lakhs rupees has been given for purchase of a car for individual director's wife or a son, then it becomes a diversion, is a misuse of the covenants mentioned in the bank loan. Even it is not under quantitative threshold, auditor has to qualify. So key takeaways for misstatements for auditors: evaluate materiality. As I mentioned, one has to go for considering what is materiality before starting of the audit process. Modify when needed. Do not issue clean opinion if the material misstatement exists. Don't hide such issues under key audit matters or emphasis of matter which are no substitute for a qualified or adverse opinion. Document everything. Maintain robust documentation of the issue, discussion with the management. We'll see the documentation part later on, is also one of the major deficiency. This documentation should include rationale behind the chosen course of action and any consultation with the management or expert for about the misstatement. Second lapse is improper reliance on management representation. What does it mean? Management representation are written or verbal statement provided by management to the auditor. These verbal statements or even written statement are considered the least reliable form of audit evidence due to their inherent subjectivity and potentiality of bias in nature. Now, standard 518-500 auditing standards emphasize the importance of obtaining sufficient appropriate audit evidence. They requires auditor to seek independent collaborative evidence from sources other than the management, and it suggests that the auditor has to apply professional skepticism, especially when the red flags exist. When you feel something is wrong, then you have to be very careful. What went wrong as far as this lapse is concerned? The auditor accepted the explanation provided by the management, and they failed to challenge the assumptions provided by the management explanation, provided in the management explanation. The auditor did not go for independent verification, failed to seek external or third party confirmation. They ignored the red flags. Case study Z Entertainment, we mentioned about 200 crores routed back to the group entities. Also, audit failure, the auditor relied heavily on management and legal opinions and then relied on legal opinions without seeking independent verification. And then critical transaction were out, because all the critical transactions, 200 crores loans to the company. Here in this case, the fixed deposit by Yes Bank Limited was appropriated to settle the loans of the subsidiary companies of Z Limited, Z Entertainment Limited. And then Z Entertainment has passed necessary entries to support this transaction later on. So, despite that, despite this material misstatement, clean audit opinion was issued. CCD, Coffee Day Enterprises. Here, auditor relied heavily on comfort letters and management assertions without performing independent verification of interest income and recovery advances. Here, there was an issue of interest income and recovery of advances again. Auditors failed to challenge the authenticity of the letters or conduct impairment testing. Advances, if you find something wrong and recoverability is an issue, then auditor must go for impairment testing. Auditor did not adequately verify loans granted to companies with no apparent operations. Here, the loans were given to the company having no operations. About crores and crores of rupees were given to the companies having the paid up capital of 1 crore with no revenue in the last 3 to 4 years. No impairment testing was conducted. In case of Reliance Capital, 6,000 crores loans were disbursed to shell entities, raising serious concerns. Here, the co-auditor resigned in the beginning of the financial year, raised a fraud alert, highlighting the irregularities in writing to the board. The principal auditor, the co-auditor, sided with the management and effectively ignored the significant fraud risks identified the co-auditor and issued that there is no fraud, issued the clean audit report. Why blind trust in management representation is risky? Why? Because audit loses credibility and objectivity if management assertions are not challenged by the auditor. Risk of fraud, management may be tempted to cover up poor financial performance if they know the auditors will not scrutinize their actions. I will take up few live cases which are in the market and in the public domain for the last about 2, 3, 4 months time. In the later slide, you will be able to know why and how the auditor did not object to the, or rather did not scrutinize the transactions and issue the clean report. Standards violated under this 200, where auditor did not challenge or investigate. 500, where auditor relied only on management explanation. 580, only auditor where it is required to use representation to support but not substitute audit evidence, where violated because auditor used representation as only sole evidence. Code of ethics is violated because auditor failed to challenge client representation. So please understand, only relying on management representation violates how many standard of auditing as well as the code of ethics. My presentation, the same presentation there before a week ago in Bhawan National Conference, where after the presentation, one of the participant, very senior lady chartered accountant, came to me. Sir, then what is the use of our certifying under true and fair? I clearly said, of course, it is my personal opinion. Please forget true and fair. Now you cannot keep shelter under true and fair. It was subscribed by ICAI at that time. Now NEFRA is sitting on the head of ICAI. So forget about the shelter under true and fair. बोल दिया कि मैंने सब देख लिया है, ट्रू एंड फेयर है, बाकी मेरा टू द बेस्ट ऑफ माई नॉलेज एंड बिलीफ, राइट? देयर आर नो मीनिंग ऑफ दोज वर्ड्स नाउ, प्लीज अंडरस्टैंड. Now, how auditor should handle management representation? Auditor should evaluate management claims critically. जो भी दिया है मैनेजमेंट ने आपको देखना है, critically examine करना है, and find out the real impact, whether it is right or not. Seek external confirmation. If you don't have the expertise to evaluate the management explanation, then go for a management external confirmation from customers, suppliers, and banks, and then third party. Legal opinions. In case of legal opinion, auditor has to ensure that it is independent and verify it addresses the exact issue and consider full facts. What are the key takeaways under the management representation lapse? As I mentioned, management statements are not substitute for audit work. If information cannot be independently verified, auditor must qualify or disclaim audit opinion. Investigate red flags. Deeper testing is required when warning signs appear. What are the documentation to be kept in the file, audit file? Question asked to the management when you are given the management representation. It should be in writing. It should be in your file. Orally मैंने ये सब पूछा था, ये सब किया था. Forget about it. Nobody is going to believe you. You have to keep the question raised to the management. Writing में उसको acknowledge किया, फाइल में रखा. Then it's in evidence. Alternative explanation considered. ये alternate management explanation दिया, उसके बाद में what is the alternate explanation? And then evidence tested. And then how you tested that evidence. Third lapse is inadequate risk assessment and planning. There are three standard auditing mentioned here is 300, 315 and 330. 300 speaks about audit planning. 315 auditor must identify high risk during the audit process before the audit process starts, and then audit plan development. Based on this assessment, a detailed audit plan should be developed. Key issues observed by NEFRA. Audit plans were completely missing. When the NEFRA start investigation, they ask the auditor कि आपका audit plan दिखाओ, हमको submit करो, आप ये document evidence से हमको submit करो. There were no audit plans. Then audit plans were not based on actual entity operation, resulting in this resulted in a superficial evaluation. It's a cut and paste from some other audit report. No response to red flags, no specific response or testing procedure were documented. In case of Man Industries in Burnpur Cement, here in Man Industries case study, the absence of formal risk assessment procedure was found. No documented materiality threshold. Materiality threshold का documentation आपको file में रखना पड़ेगा. What is the materiality that you determine for the audit process? You have to keep this in file. right? So there was no materiality threshold was found in the file. So without materiality threshold, how can you define material misstatement? एक 5 लाख रुपये का एंट्री है और 50 लाख का एंट्री है, तो 5 लाख को मिसस्टेटमेंट बोलोगे या 50 लाख को मिसस्टेटमेंट बोलोगे? हाउ यू विल बी डिटरमाइंड, राइट? So you need to go for a materiality threshold and then keep it in a file as an audit evidence. So despite pervasive, in this case, despite pervasive, extensive impact of the misstatement, risk response were not documented. In case of Banpur, no documented audit strategy were found, and an absence of a detailed audit program to guide testing procedures were not available. Non-performing asset and contingent liabilities were failed to be reported by the auditors. So here 300, 315, 330 completely ignored. DHF branch audit, it's very important. ये दीवान हाउसिंग फाइनेंस लिमिटेड का कंपनी का फ्रॉड हुआ था, if you remember, before 2 years back, and then here the auditor will also came in the picture. जो भी फ्रॉड आएगा उसके बाद में ऑडिटर की जान निकलेगी ही, वो पक्का है. I mean now उसके बाद में नहीं आएगा वो, उसके बाद में बिग कंपनीज है, आई विल गिव सम एग्जांपल, वो MCA भी आएगा, SFIO भी आएगा. So probably ED can also come if violation of money laundering or something is found to that sort. So here in this case, auditor, the principal auditor, the parent company auditor, audit began without formal engagement letter. Can you start your audit process without formal engagement letter? किसने क्लाइंट ने बोल दिया साहब आप ऑडिट चालू कर दो, हमको जल्दी करना है, नो फॉर्मल एंगेजमेंट लेटर. उसके बाद में रह गया, ऑडिट रिपोर्ट साइन हो गया, रिपोर्ट सबमिट हो गया, रिटर्न फाइल हो गया, देयर वाज नो एंगेजमेंट लेटर ऑन द रिकॉर्ड. So IFC reporting 143, this is very important. See, auditor has to look at the presence of internal financial control within the organization and report its weakness. If the weakness is affecting financial statement or disability material, so there are 2 provisions in Companies Act. 143(3)(I) mention about the weakness. Auditor has to mention कि weak है control. Or if the impact of the weakness is larger in affect the overall financial statement health, then it has to be reported under 143(3)(F) as an adverse effect. It goes to the modification. Here audit conducted without specific risk documentation and auditor perform routine check without tailoring the audit procedure. There is no audit procedure. आपको फाइल में देखेगा where is the audit procedure, आपने कैसे audit start किया. There is no, if that is not available, then you are held responsible. Even though audit report is issued, the audit I will mention in a later slide, it would be considered there is no audit done. Relevant standard violated here in this SA 300, no audit plan or standard copy paste template used by the auditor. एक दूसरे का copy paste करते हैं audit plan में चिपका दिया and it was present to नेफर है, बोला कि क्या है, this is not related to this country and these entities operations, right? SA 315, no documentation for internal control analysis. 330, no evidence of tailored audit procedure. And SA 320, materiality not documented or justified. As I mentioned, materiality is very important. Plan and assess risk properly is a key takeaways for the auditors. You have to, before you formalize the audit process, audit plan, you have to analyze business operations, systems and past issues, review financial statement, internal financial control, identify and spot vulnerability, unusual transaction, related party transactions, prior fraud history available in the company, and media reports about this company. Nowadays, media is very active. For if you find, if you are appointed the auditor of a large company, you must verify and then go for a Google search about the media reports about any misstatements or frauds or diversion of the money for that company. Then accordingly you can revise your audit plan and consider the risk factor available. So update the plan as and when the new information becomes available or circumstances change during the audit. This is also important. Fourth lapse is neglect of fraud risk procedure. 240 has become very important. Nowadays, because of the fraud and diversion issues have been found out by SEBI, it is mandatory responsibility of the auditor to assess and respond to the risk of material misstatement due to fraud by maintaining professional skepticism. Auditor failed to perform fraud-specific procedure, ignored red flags in RPTs and then circular transactions, over-reliance on management representation, and despite fraud indicators, no modified opinion and no communication to those charged with the government. If you find something wrong, and if you decide to go for a modified opinion or emphasis of matter, you must communicate to the management. Management include the board of directors and or audit committee and chairman audit committee. This is very much required. Without their informing, simply you cannot go for a qualification. Coffee day, as I mentioned, fake interest income, evergreening of loans, these were all available despite auditor has issued the clean report. Auditor has, in this case also, auditor heavily reliant on management assurances. In Brightcom, equity infusion 860 crore were no share issues and no fraud risk assessment conducted despite red flags available in Brightcom when the audit started. Case study, Z Entertainment 200 crore loans to the associate companies. This was a classic case of a round tripping of the fund. Fraud. Auditor accepted legal opinion and did not go for an independent view. And then there was no assessment how the transaction was structured to deceive the shareholders. To deceive the shareholder. The NEFRA has used the word deceive. Auditor has completely forgotten to verify how and why the management has structured the transaction to deceive the stakeholders. Auditor, so इसके लिए SEBI also held the auditor responsible vis-a-vis the NEFRA also. Reliance Capital, these 6,000 loans were given to sale companies, were completely evergreening of the loans. Despite, as I mentioned, co-auditor resigned and issued the potential fraud, principal auditor did not take action and issued the clean report. Standard violated 240, 200, 230 and Code of Ethics. No procedures were undertaken for fraud, risk management, and then Code of Ethics, auditors avoided conflict with the client management. This is very important. That is the reason I have highlighted this. Normally, in normal circumstances and parlors, the auditor normally don't go for a conflict with the management for issue of the qualified opinion. इसीलिए मैं एक एग्जाम्पल देता हूँ आप, when you have the time, go for very recent audit report issued by the auditor for Northern India Regional Council of Institute of Chartered Accountants of India. Why I am saying it's ICAI? There are so many irregularities found by the auditors. So auditors had mentioned all irregularities under emphasis of matter under other matter paragraph. Of course, did not qualify and then raised doubt about the going concern. Please understand why I am stating this example. When an auditor, a member of the institute, has the courage to write such things for the institute balance sheet, why can't we as individual members for our client? That is the reason I am mentioning this. When you get the time, you please go through the audit report issued by the Delhi-based auditor or Ghaziabad, Northern India, for NRIC balance sheet, which is just signed 15th of May 2025. It's very important. You will be able to know what kind of irregularities can be found in ICAI balance sheet, and particularly the courage of the auditor to mention and report. Fraud indicators, auditors should watch for related party transactions, circular payments, unusual advances, one-off transaction, write-offs, and journal entries that bypass standard processes. These are the critical indicators you should look at while auditing the books of accounts. How comply with the 240 is very important standard of auditing, because the fraud cases are reported day in, day out, every month or 2 months, one large fraud are reported. team brainstorming to discuss how fraud could occur. When you are auditor of a large company and you have some hint about some irregularity in the past, your team should brainstorm about how fraud assessment should take place. Update risk assessment, unusual test controls on unusual journal entries and adjusting entries, particularly nearly year end. In the last quarter, normally adjusting entries, journal entries are being passed for such wrong transaction, fraudulent in nature. Auditor must look into this. Surprise procedures, auditor should perform unannounced stock checks and direct confirmation, unannounced cash counts, inventory observations, or confirmation with the customer and suppliers. And this, you need to keep this in your file. So tomorrow, if there is an allegation by SEBI or NEFRA, you should be able to defend yourself. My sole purpose of this presentation is only to make you aware that you need to protect yourself in the eventuality of something go wrong tomorrow. But then all these things will save you, will defend you to the extent possible. Key takeaways for auditors: mandatory assessment, fraud risk assessment is not optional, but mandatory for under SA 240. Investigator indicator, आज की तारीख में जितने you must have read in Economic Times and Times of India, mainly Economic Times Business Standard, about big frauds and diversion of money, and then NEFRA's then institute started suo motu action against those companies under FRRB. First of all, they look at SA 240, whether the auditor has performed properly and then followed 240 properly or not. So related party transaction, due diligence, you need to take care. Report to the governance if you find the issues wrong, and if the fraud kind of transaction is found, which is value added is more than 1 crore as per the Companies Act, under 143(12) of the Companies Act, you need to inform the central government. After it is informed to the board, and if the board submit you the report, and then later on auditor is required to inform to the central government about the fraud. Fifth deficiency is audit documentation, SA 230. Now, I am always telling that only members or engagement partners or quality control reviewers only should not attend this kind of program. All your senior audit people should also understand this requirement, because ultimately auditors, the partner's entry comes at a later stage after the audit is over. Here, all this your staff take care about the documentation. What was audited needs to be in the file. What evidence was obtained, what conclusions were reached, and who did the work and when. Time stamp is required. आपने ये journal entry किसने किया, कब check किया, the name of the person and the time. Auditor must ensure compliance under 300, include sampling plans, materiality threshold, or if you go for a sampling, then also materiality threshold you need to consider. This is very important. Log the file within 60 days from the audit report date. This is normally not done. आप छोड़ देते हो. After the audit report, audit file completion, which is considered audit file completion date. So, after you sign the audit report, you need to close the file, audit file, within 60 days. अच्छा sorry, इसमें वो फाइल में clearly it should be mentioned that who performed and reviewed the work and when to ensure accountability. What went wrong in NEFRA orders? They found incomplete files, incomplete audit files were submitted, backdated documents created after audit reports was signed, maintain only template files by the auditors. DHFL, Man Industry, Coffee Day, the cases remain the same, but the deficiency found under the different heads. So again, these are the repeated cases of those case studies. Here, in case of a DHFL, the audit file was completely found to be entirely blank, right? And then materiality calculation was not available, fraud risk assessment was not available, internal control evaluation was not done properly under, as mentioned under 143(3)(I). Man Industry, very important. working papers included reference of GST in case of mart industry, though audit year 15-16 was pre-GST era. This is nothing but a cut and paste. कहाँ से लेके आए? जहाँ GST था ही नहीं, then your audit file speaks about the GST. Copy paste error, as I mentioned. So critical judgments were not properly documented, and then essential documents were inserted into the audit file after the audit report was issued. Key areas of the audit verification were loans not adequately supported by sufficient and appropriate audit evidence. So audit evidence is extremely critical, important part of the audit process. Now answer Lexus Granato case study. Very important to note that the company has provided two separate files, one to the National Stock Exchange, BSE and NSE, and another to NEFRA. And then they were not knowing that both the agencies work in tandem with each other. कि हमारे पास क्या फाइल है, तुम्हारे पास क्या फाइल है. They found that two different files were submitted and mentioning different documents. Reviewer denial, very important. The EQCR, Engagement Quality Control Reviewer, denied any involvement with the firm. So if you are a large auditing large companies, whosoever signed the EQCR report has to have, your audit file should have a confirmation about he has agreed to become a EQCR reviewer. Otherwise, what happens in this case, the investigation commenced after 2 or 3 years of the audit report issued. At the time that EQCR partner left the firm, and then he said, no sir, मैंने तो ये किया ही नहीं है. तो आपकी फाइल में वो EQCR रिव्यूअर का कन्फर्मेशन होना चाहिए. Yes, I have agreed to become a EQCR reviewer. तो आप how will you save yourself? वो तो चला गया. This has exactly happened in this case. So sampling plan missing था, internal control assessment missing था, materiality threshold missing था. Why documents failures are serious? Because it's a legal evidence. Tomorrow it can always save you when something goes wrong. Critical piece of evidence in legal proceedings. If document is incomplete, then it raises concerns of professional negligence, false reporting, audit malpractice, and NEFRA penalize and debarred auditors for maintaining fake or insufficient documentation. The kind of penalty I already mentioned initially. Here also standards violated 230 for keeping the files blank or post facto created, 300 no strategy for audit planning, 320 no materiality threshold was determined, and under SQC1 no review trail or partner sign off for under the SQC1 or EQCR review. Key takeaways audit documentation, आपको क्या ध्यान रखना है, and what kind of precaution auditor should take as far as not to repeat the mistakes or lapses under audit documentation. Documentation is the, it's a complete AC is not working. है ही नहीं. I'm very surprised. So auditor is not optional. Documentation is the foundation of the audit, and it is essential for supporting the auditor's opinion. And the regular inspection, quality control partner should regularly inspect files for completeness and accuracy. See, EQCR reviewer role becomes very important. Say audit mein there are two important personalities. One is the engagement partner, audit, who does the audit. Another is the EQCR reviewer. So the EQCR reviewer, quality control partner, should regularly inspect files for completeness and accuracy. ऐसा नहीं होना चाहिए audit process हो जाने के बाद, audit report issue जाने के बाद EQCR reviewer आता है, बोस आपने कहाँ क्या किया, आप मुझे बताओ. And then backdated reports, backdated documents are created and filed. NEFRA says that if there are no documentation, we will consider that no audit was performed. Despite you signed the balance sheet, despite you issue the audit process, NEFRA will say that no audit was performed, because there was no, it was not substantiated by the evidence. No verification of recoverability and provisioning. So recoverability is normally look at as far as verifying for loans, advances, security deposit and receivables. Auditor needs to verify for provisioning in impairment if amounts are overdue for a longer time. No legal enforcement is seen in recovery and counterparty is facing financial problems. This you can always cross check through the media reports. If suppose a company has given advance of say 5 crores or say 25 crores to XYZ company which is outstanding for 2 years, and then company said no, everything is okay. But if you find some media report that for that company NCLT proceeding, somebody has started NCLT proceeding, insolvency proceeding, right? Then it becomes the issue of the recovery. You must go for impairment testing and provisioning in that case. So standard violated 500, 505, 540, 700. What went wrong in NEFRA case is auditor failed to test recoverability and accepted management assertion, relied heavily on management presentation, issued clean report without any qualification, and these failures cause material misstatements. This is very important. Sobha Limited, SRH Limited and Brightcom Limited also again the same unsecured land advances with no title, no confirmation from third party, no provisioning, despite that clean opinion was issued. These are all real estate companies, right? 1 and 2. Auditor did not go for independent confirmation, no attempt by auditor on credit assessment of the recipients. You need to go, if you are verifying the loan transaction, you must go and verify the financial statements of the loanee, whether it is, they are in a position to repay the loan obligations, and where the loans were issued vis-a-vis the loan document speaks. What auditors should have done? Review the contracts. As I mentioned, auditor thoroughly should examine the legal documentation pertaining to advances and loans, actively seeks external confirmation in case of the loans and advances, review aging schedules to determine the length of time receivables, assess the likelihood of recovery, and then recommend impairment provision. Standards and regulations violated 500, 505, 540, 705 because India's 109, no impairment testing was undertaken despite the recoverability was at a question, right? Why verification and provisioning so critical? Because it prevents the fund diversion. Testing recoverability rigorously prevent the misuse of advances. So, because otherwise it affects the profits and net worth of the company, and then you lose the confidence of the stakeholders. Takeaways for the auditors: you should test material advances receivable for collectibility, for recovery, aging analysis, external confirmation, assess provision as per India's 109 AS4 for which is called a credit loss provision, and modify opinion if needed. If impairment is evident but not booked, consider modified audit opinion. If you find that recoverability as issue, the company has not provided, then you go for the modification of the audit report. Misuse, the 7 lapse, misuse or omission of modified opinions, 705, 706, these 2 standard issues speaks about the modified opinions. Here, as I mentioned in earlier slide, either it has been the modified opinion, either it has been qualified or adverse or disclaimer. And an auditor must carefully evaluate the nature and pervasiveness of the issue to determine whether it is qualified or adverse or disclaimer. And then emphasis of matter, auditor can mention about emphasis of matter if the matter is already disclosed, it is not a misstatement, and emphasis of matter is not a substitute or a modified opinion. Now, as I mentioned about the NRIC balance sheet of ICAI of 2024-25, here the auditor has mentioned all these irregularities in the EOM, but under the paragraph other matters. Under other matters of EOM, which is completely distinctly different with EOM normal disclosure, if auditor found something uncertain about the company or the issue of a going concern, then auditor normally use other matters under EOM, where you will find, you read out 4 or 5 pages audit opinion of NRIC ICAI. Types of modified opinion, as I mentioned, either qualified, adverse or disclaimer. If the material misstatement is exist but is not extensive, then qualified. Adverse, material misstatement are both material and pervasive and it affects overall reliability, that is pervasive. And if auditor can't obtain sufficient evidence and believe material misstatement could be pervasive, as far as a loan are concerned, if the loan recoverability an issue and you don't find any evidence about the recoverability issue, and then legal enforceability is also doubtful, then you should go for a disclaimer of opinion about those, because the provision is also not available, and then recoverability an issue, then you go, because the sufficient evidence is not provided by the management, then you should go for a disclaimer of opinion. But what went wrong in NEFRA cases? Misuse of modified opinion under 705, because NEFRA found that auditors encountered material misstatement, did not qualify, used EOM to mention the issues without modifying the opinion, and resulting in a clean report that gives false assurance. Reliance Capital we mentioned, we discussed the earlier. Only in case of Banpur Cement, auditor failed to report 15 crore NPA interest not recognized, which is against Ind AS 109. Undisclosed tax demand, auditor did not bother to inform and then report about the undisclosed tax demand of 17 crores. And then auditor used EOM, emphasis of matter, to draw attention, but issued a clean opinion. As we mentioned in earlier, taking shelter under EOM, but without issuing the qualified opinion is again very big problem for auditors. Sobha Limited, as I mentioned, land advances without ownership. Standard violator 705, 706, 700, opinion, keen opinion without, despite pervasive issues. EOM to avoid qualified opinion, that is 706, and 70 mislead users with unmodified opinion. If you don't issue the modified opinion despite the misstatement, then you are covered under 700. This is a big slide. I require 10 minutes time, lot of time, because I have tried. I think you must be circulating this presentation to the members who participate. If required, I can also circulate. This is very important. I put a lot of efforts to differentiate, because members have a lot of confusion about when to use KM, when to use EOM, and when go for a qualified opinion. So I have bifurcated is a complete chart about different particulars, and then when it has to be used, when it should be triggered, when use cases, kind of use cases, under which cases key audit matter are to be reported, under which cases emphasis of matters are reported. I will only take the use cases for example. Complex accounting estimate and fair value litigation, revenue recognition, where uncertainty is not there, but auditor has to report KM. But if the going concern uncertainty is there, major subsequent event disclosed after the balance sheet date and contingent liability are available, then you should go for a EOM. And the material misstatement not corrected by the management, then go for either qualified adverse, and the scope limitation go for a disclaimer. So location and all auditor responsibility mentioned, requirement in all audits. Yes, KM it is required for all listed companies. Under EOM it is not mandatory. It is applied based on auditor judgment, but in case of modification arises when audit opinion must be qualified, adverse or disclaim as the case may be. Why misuse of EOM is serious issue? It misleads the users. As I mentioned, use EOM or skipping modification hide this risk. Professional misconduct, NEFRA consider this as a gross failure in reporting responsibility. Gross failure in reporting responsibility. How to use EOM and modified opinions corrected by the auditor. Assess, as I mentioned, assess materiality, determine if the issue is misstatement, considering the materiality threshold, whether it is quantitative materiality threshold or qualitative materiality threshold, I have explained earlier. for a loan violation, loan agreement violation with the banks, even it is for a 1 lakh rupees, then it becomes a qualitative misstatement, you must report. Use qualified or adverse opinion when needed and clearly explain the reason for the opinion type in audit documentation. When you go for either emphasis of matter or modified opinion, how you arrived at this conclusion? What are the documents you gathered? What kind of discussion you had with the management, and how you arrived at a judgment? What is the rationale behind this judgment? You must document and keep this in your file. Key takeaways, as I mentioned, EOM issues, document reason, proper maintenance of the document. For EOM issue, NEFRA says do not misuse EOM to avoid opinion modification. This is nothing but deceptions as per NEFRA. If you cover EOM and don't go for a modification, it is not accepted by NEFRA. What is the guiding principle? NEFRA says if the user of financial statement would change their decision if they knew the issue, then modify their opinion. आपको खुद सोचना है कि you are a user and ये मुझे पता चलता है, and if I change my investment decision or other decision to invest the company, then go for a modification. 8 lapse is non-compliance with key standards, because these are all backbone of audit process. Risk-based audit planning, reliable audit evidence, appropriate audit judgment, we all discussed. So non-compliance implying the audit was not done properly even if a report was issued as per NEFRA. Major standard repeatedly violated: 500 for audit evidence, 505 external confirmation, 315 material misstatement, 330 audit response to audit risk, and 260 communication with those charged with the governance. See, if you issue emphasis of matter and go for a qualified opinion and did not inform the management, those charged with the management, those charged with the governance, that is board of directors and audit committee, then also you are held responsible under violating standard of auditing 260. Communication with TCWG is extremely important. SA 540, auditing, accounting, estimate, recoverability, impairment and violations, testing estimates and challenge of management assertions we discussed earlier. Consequences of violation of key standard of auditing. Professional negligence, NEFRA can आपको कठेरे में खड़ा कर सकता है because of you are not professional, you not use the professional skepticism, right? Misconduct as per different parts of the CA Act. Audit failure, audit was not performed at all despite a signed report, NEFRA has concluded. Why these standard audit are important? As 500 and 505, audit becomes guesswork without evidence. What NEFRA says, audit becomes a guesswork. If you don't keep the audit evidence, then it becomes a guesswork. It's not audit done, even though despite audit report is issued. 315 and 330 may miss fraud or major misstatement, and 540 overstated assets. If the key estimates and judgments and then key impairment provision is not properly taken care of, then it becomes the issue of overstated assets or fake value remain unchecked and violation of standard of auditing 540. Key takeaways: you must plan the audit process and you have to tailor it particularly considering the entity operations. Test and record all assumptions and engage with the government. As I mentioned, you must communicate with the board or audit committee for any violation you find out. So what NEFRA says, failure to follow these basic standards amount to audit failure, even if report is issued as per NEFRA. RPT. What are RPT? We all know RPT, so I am not going to much details about explaining what is RPTs. Here the issue is conflict of interest and then going the transaction without arm's length consideration. 550 require auditor to identify RP and relationship, understand nature and purpose of RPT, evaluate and verify arm's length and approvals. right? Ensure proper disclosure in financial statements. Treat RPTs as high-risk areas since they are often used to shift profit or losses, divert funds, and fix asset transactions. What went wrong in NEFRA cases on RPTs? Auditor failed to report related party and the relationship. They failed to report arm's length pricing. They ignored lack of approvals from board of directors or shareholders, and as far as AGM and EGM is concerned, as far as the shareholders approvals are concerned, and then overlooked signs of round tripping or circular transactions. Coffee day, as I mentioned, fund diverted to various group entities is round tripping of funds, false interest income books. In case of Lexus guarantor, balances were net off in violation of Schedule 3 and accounting standards. Here also arm's length basis and verifying BOD approval was not found. Audit report covered KF, but no modification or qualification. As MAN Industries also, the arm's length pricing were not observed by the auditors, and BOD approval they did not verify. It was not on record. A related party transaction has to be approved by board of directors, and it has to be on record. Auditor has to verify this, and auditor has to keep this in an audit file, their board approval, the resolution of the particular board. Auditor neither challenged classification nor verified compliance with Ind AS 24 as far as these RPTs are concerned. Standard violated 550, 500, 260, 265, Schedule 3, as I mentioned, netting of advances, 260, no communication of RPT risk to the governance. Key takeaways for the auditors for related party: please consider RPT as significant risk, test them thoroughly. Never assume management disclosure as complete. Ensure contract, each and you have to go for verification of the contracts. Suppose it's a rent to related party, hiring the office or a go down from the relative of the promoter. You must go for the contracts or agreements which are signed, pricing logics, whether it's arm's length or not, and approvals of the board of directors is in place or not. Communicate RPT risk to the governance and ensure that all stakeholders in the audit committee and senior management are informed of the risk associated. And be prepared to adjust audit opinion if the transactions are deemed to have a material impact on the financial statements. Last but very not least and very important, because normally it is not considered by the audit firms, and then nowadays NEFRA is taking a lot of reliance and lot of weightage, putting a lot of weightage on whether the quality control parameters are observed by the firms and audit partner, the engagement partner or EQCR partner as far as the audit process which are undertaken, right? This takes place only after the fraud takes place. I'll give the example in the next slide about the EQCR, and then the current case is what NEFRA is going to review it, and then within next 2-3 months or 6 months, you will be able to read in the newspaper what I am saying here. For SQC1, standard on quality control for firms, it applies to all firms performing audits and mandate that the firm establish a system of quality control to ensure. This is not quality control, internal control mechanism of our client. This is a quality control mechanism for our firm itself, right? So, to establish a system of quality control to ensure audits are conducted as per the standard of auditing, professional standards, ethics and independence. All reports are appropriately reviewed and monitoring documentation. Now, NEFRA will ask you, okay, you said all audits are conducted as per SA and professional standards. आपने लिख दिया yes, but then they will say, okay, justify. How you will be able to justify without documentary evidence? So, all the transactions where the essays are applicable standard of auditing, you have to write this essay 240 fraud risk procedure, how you have reviewed this, whether the fraud have taken place, no, what kind of transaction you have verified, whether you have undertaken for a doubtful transaction discussion taken place with the management, document evidence, management reply, document evidence, and then your judgment, logical conclusion as an evidence. You must keep this in file because you are going to be questioned. आपने बोल दिया हाँ मैंने किया है quality control, पर कैसे, how, you have to justify. So, for engagement quality control review (EQCR), it is mandatory for all high risk audit listed public interest entity complex engagement EQCR to be conducted by senior experienced auditor not involved in the audit process. Because the EQCR reviewer has to review significant audit judgments, assess whether audit report is appropriate, ensure compliance with standards and regulations. What went wrong in NEFRA case is EQCR failure audit. NEFRA found that completely failure of EQCR, false representation, lack of documentation, internal deficiency about internal control process within the firm, and serious lapses as per the quality control were found. Case studies NEFRA orders as far as the EQCR and SQC violation. In case of Banpur, EQCR was falsely claimed to have been performed, but they did not provide any document evidence that yes, हमने EQCR किया है. उन्होंने बोला कि किया, as I mentioned, आप बोलेगा बताओ हमको क्या है, कहाँ से किया आपने? No, nothing. Person named as EQCR reviewer denied any such role, क्योंकि वो फर्म छोड़ के चला गया था 2 साल के बाद, और उसका कंफर्मेशन था ही नहीं फर्म में कि भाई whether this guy has performed as a EQCR reviewer, right? So, no documentation to show any quality review. Lexus Granito, no EQCR was done despite being a listed company and undergone preferential allotment of equity, fake equity infusion case. Audit filed had no review notes. NFIR concluded that firm lacked basic SQC1 compliance. Violation SQC1, EQCR, no policies, no EQCR was performed, code of ethics, no independent checks, SA 220, no partner level review of key audit decisions. Say engagement control review partner has to undertake all this review which was not found on record, then it becomes the case of violation of standard auditing 220. Key takeaways for auditors. These are the 9 key takeaways for auditors for not falling under this lapse. EQCR is not an optional but is mandatory. Without proper EQCR and XQC1, firms cannot ensure audit quality. Appoint independent qualified EQCR reviewer for listed and high risk entities. Maintain documentation of review notes is extremely important, rather critical to note that you need to maintain documentation of the review notes, changes suggested by EQCR and final approval before report issuance. Firms must have working SQC policy in place, avoid reliance on management and legal opinions, escalate red flags proactively, adopt forensic lens in audits involving RPTs. I was going through one of the, I think, audit seminar or conference organized by Ahmedabad branch in shortly, in which I could find this topic to be taken up by Mr. Aniket Talati, right? All auditors now have to act as a forensic auditor, right? I could see that. So, time has come. You have to look at all the audit process, all the transaction review as if you are a forensic auditor. So, never delay or backdate documentation. फाइल इंटेग्रिटी इज नॉन नेगोशिएबल. आप बैकडेट से कोई डॉक्यूमेंट ऑडिट फाइल में रख लेते हो. एज आई मेंशन, आफ्टर द ऑडिट रिपोर्ट इज साइन विद इन 60 days यू हैव टू क्लोज द फाइल. नाउ लास्ट स्लाइड, very important, is related to all current transactions, or not transaction but the transaction reported wrongly with the regulators. One is the IndusInd Bank, you all know the wrong derivative transactions reported, some internal control issues were found out, and then in case of Gensol Engineering Limited, your Ahmedabad based company, right, here also possible violations are reported. So, NEFRA has issued the suo motu action under AQR, Audit Quality Review, under 132(4) of the Companies Act for IndusInd Bank as well as Gensol Engineering Limited. ICAI has also initiated a suo motu action, suo motu inquiry under FRRB board for inquiry for these lapses for these 2 companies. So, surprisingly, go through the audit report of these 2 entities for FY 23-24, because all the fraud and then possible violation have taken place during the FY 24-25. This is very important exercise and you will satisfy yourself. Go for IndusInd audit report 23-24, year ending March 24, and Gensol Engineering Limited. See the audit report. Clean audit report have been issued. That's only I can tell you, but you have to look at it. You have to use the wording used by the auditor. Now, the investigation which are going to take place, which are taking place rather by NEFRA, ICAI and then SFIO, they will verify all transactions and whether the auditor have taken proper cognizance of the matter, use professional skepticism, professional negligence was found or not. All these things were found and then they will ask the auditor whether why you issued the clean audit opinion. Right? These are going to happen. I mean, this is my independent view, of course, for this. So you must carefully monitor this development that are going to take place. For Gensol Engineering also, the violation of internal control mechanisms are also going to take place. Why the fund diversion to a great extent by the promoters have taken place and whether internal control mechanism are found out or not under section 143(3)(I) and 3(F) and why the auditor has not reported the violation. This only 10 days old case of technology platform VIRC Innovation Company is a Bangalore based company. If you read out some news portals, the Daily Hunt करके एक portal था, अभी है कि नहीं मुझे पता नहीं, I don't remember, but there is a parent company of. Now, VIRC Innovation raised about $800 million from world-known investors like Facebook, Google, and then very known investors, $800 million. Despite the presence of all these investors, I have the pains to note that this kind of corporate governance failures, internal control mechanism failures were reported now. What did they do in the board by sitting in the board despite heavy $800 million? So हो गया 8,000 into about 60,000 crores investment in the company despite no internal control mechanism. This VIRC company has undertaken this round-tripping transaction with this company, Builder AI, it's a London-based startup company, amounting about $60 million. वो इन्वेस्ट रेस करता है इंडियन कंपनी के सामने, सेम इनवॉइस इशू करेगा इंडियन कंपनी लंदन बेस के कंपनी. ऐसा 4 साल से चलता है विदाउट ऑफरिंग दिस सर्विसेज बीइंग रेंडर्ड मेंशन इन द इनवॉइस. What auditor did do? What internal auditor did do? Why they did not find out such lapses? Why did not find out such things which goes under the nose? All these people will be now कचेरी के कठेरे में खड़े रखेंगे नेफ्रा, and I'll tell you they will be debarred, they will be put maximum penalty. All Chinese companies operating in India are also under scanner, Oppo, Realme, Xiaomi, Vivo, all under regulatory scrutiny. You go through the audit report of these companies for 23-24. This is an exercise for you guys. And within 6 months, you will be able to know what kind of auditors are going to face music from the various regulatory authorities. This is last but not very important for, this is my independent view. Let me have my disclaimer under this. This is my independent view. For internal auditors, NEFRA primarily oversees statutory auditors. Internal auditors can also be held accountable if their negligence contribute to financial irregularities which arise from failure to detect or report fraud due to non-compliance with standard of auditing or lack of professional skepticism. And under this case, NEFRA may initiate action under 132(4) of the Companies Act against internal auditor as well. these days are going to come very shortly. If you are internal auditor of the listed company or subsidiary of listed companies, and then such frauds are found out, then internal auditor definitely, according to me, are going to face the music. These companies I have mentioned, I am sure internal auditor will also be held responsible, according to me. This is my independent view. So these are all. Thank you very much for patient hearing, and then I am ready if any question answer are there. The branch can take up the remaining part of the session, please. Thank you.
It's my immense pleasure to give a vote of thanks to CA.Sanjeev Shah, sir. Thank you, sir. Now we conclude sessions here. Thank you.